Hi everyone and welcome. I'm Mike Werner, and today we're going to be looking at cost terms and concepts for a manufacturing company. Manufacturers incur significant costs to get their products ready to sell. Products must go through the entire manufacturing process before they're ready. The main components of manufacturing cost include direct material cost, direct labor cost, and manufacturing overhead cost. Direct material costs are the costs that can readily be traced to a unit of manufactured product. For Ford Motor Company manufacturing automobiles, direct material would include steel in the frames and bodies, plastic, glass, tires, engines, seats, and more. Not all materials incorporated into the product are considered direct material. Some materials are difficult to trace to individual units of production and are treated as indirect materials cost. Examples include ink, glue, staples, tape, and other insignificant or difficult to trace materials. Indirect material cost is considered part of manufacturing overhead. We'll talk more about manufacturing overhead in just a few minutes. Direct labor cost includes the cost of production labor that can readily be traced to individual units of product. Direct labor is sometimes called touch labor because it's the cost of workers who actually touch the product as they're manufacturing. For Ford Motor Company, direct labor would include the cost of assembly line workers. Direct labor does not include all factory labor costs. Manufacturing labor costs that benefits multiple products is called indirect labor. Examples include the cost of factory security guards, factory janitors, factory maintenance workers, production supervisors, and so forth. Indirect labor cost is considered part of manufacturing overhead. Manufacturing overhead cost includes all the costs associated with manufacturing products other than direct material and direct labor. Now that description is a little bit lame, so let's talk about it further. Sometimes manufacturing overhead is called factory overhead, indirect manufacturing cost, indirect factory cost, manufacturing burden, or factory burden. As opposed to direct material and direct labor, which are direct cost, manufacturing overhead includes all indirect manufacturing cost. Examples include indirect material, indirect labor, factory rent, factory electricity, telephone and internet service, and the cost of any other utilities, factory insurance, factory property taxes, factory depreciation, and all other costs aside from direct material and direct labor. We should bear in mind that manufacturing overhead includes only costs of manufacturing. If we were to draw our factory, let's say this is our factory building. Here we go, there's our factory. And let's say that this factory building also includes, say, some space for the administrative offices and also some space for the sales offices. And in this area down here, we have the factory. So all the goods are manufactured in this area of the building, okay? So when we talk about manufacturing overhead, we're talking about the cost associated with this area of the building, not the cost associated with the administrative offices and not the cost associated with the sales office. So if we were to look at a cost such as factory rent, maybe the rent on the entire building is, say, $10,000. And if you just look at it, it looks like the factory occupies about 75% of the square footage of the building. That would mean the rent cost associated with the factory is $7,500. Now, the rest of the rent, or $2,500, is associated with the administrative and sales offices. Perhaps, $1,000 is for the administrative offices and $1,500 for the sales office. So when we're talking about manufacturing overhead, we're talking about the cost associated with the manufacturing operation, That would be the factory cost. We don't want to include any cost associated with our administrative offices or our sales office. Now, manufacturing overhead is an indirect cost, and it cannot be traced to individual units of production. Rather, as an indirect cost, it must be allocated. Now, there's a couple of ways of doing this. One method is traditional manufacturing overhead allocation. Another method is activity-based costing. Traditional manufacturing overhead is most popular. And what happens here is all the manufacturing overhead cost is pooled into one large cost pool. And then direct labor hours or direct labor cost or machine hours is used to allocate the overhead cost to products. The idea is that the allocation base is correlated to the incurrence of manufacturing overhead cost. On the other hand, activity-based costing takes a more accurate approach. What happens with activity-based costing is we create smaller manufacturing overhead cost pools that include the manufacturing overhead cost associated with various manufacturing overhead activities, such as the cost of setting up production equipment, or the cost of inspecting products, or the cost of material movements within the factory, or the cost of factory engineering. And then what we do is we allocate those costs based on cost drivers. A cost driver is an activity or volume that causes that cost to occur that can be used to allocate the cost. A key here is it causes the cost. That's key. It causes the cost. And it's some activity that we can use to allocate the cost as well. Examples would include number of setups for setup cost, number of material movements to allocate material handling, number of engineering hours to allocate factory engineering costs. Activity-based costing is viewed as a better and more accurate way to allocate manufacturing overhead. However, it's more difficult to do and it's more costly than traditional manufacturing overhead allocation. Now let's talk about some ways to group product cost. Grouping product cost is sometimes helpful. Prime cost is the combination of direct material cost and direct labor cost. It does not include manufacturing overhead. Conversion cost, on the other hand, is a combination of direct labor and manufacturing overhead cost. Conversion cost does not include the cost of the direct material itself. Rather, it's the cost of the direct labor and manufacturing overhead used to convert the direct material into a finished product. Prime cost includes direct material and direct labor cost. Conversion cost includes direct labor cost and manufacturing overhead cost. Now let's talk about inventory classifications for manufacturers. Unlike merchandisers that have just one classification of inventory, manufacturers typically have three classifications: raw material inventory, work in process inventory, and finished goods inventory. Raw material inventory includes material on hand that can later be used in production or otherwise used in the factory. It's material on hand that has not yet been used in the factory or moved into the production process. Work in process inventory are the products that are in production, but they have not yet been completed. So if you visit a factory and you see various products in the process of being manufactured, you're looking at their work in process inventory. Now, once products are completed, they become part of the company's finished goods inventory. Finished goods inventory includes the products that have been completed and they're ready to sell. So when we first buy material, it goes into raw material inventory, and then as we put it into production, it becomes part of our work in process inventory, and finally, once it's completed, it's transferred to finished goods inventory where it awaits sale to customers. Now let's take a look at the cost flow for a manufacturer. First, raw material is purchased and it becomes part of our raw material inventory. Some of this raw material is used as direct material and is put into work in process inventory. So the cost of direct material would be transferred into our work in process inventory. Direct labor cost is also recorded in work in process inventory. So instead of expensing direct labor cost as direct labor expense or factory expense of any kind, instead the cost of the direct labor is placed in work in process inventory. And the idea is that the direct material cost and the direct labor cost are required to manufacture our product. Now, some of this raw material is not used as direct material, but instead used as indirect material. The indirect material, as we mentioned previously, becomes part of manufacturing overhead, as we see here. And manufacturing overhead costs are all accumulated in one account, one big, what we might call a cost pool. Some companies, if they use activity-based costing, would have many cost pools for manufacturing overhead, but let's assume our company uses traditional overhead allocation. So basically, all the overhead costs are placed here. Then what happens is these costs are allocated to production, and they become part of our work in process inventory. So indirect materials, indirect labor, factory rent, factory depreciation, and all these other manufacturing overhead costs are first placed in the manufacturing overhead account, and then later they are transferred to work in process. Notice they are not expensed. They are all considered part of the cost of manufacturing our product, and therefore we place them in the work in process inventory. Now, once goods are completed, we move them from work in process inventory to finished goods inventory. So in the factory, they're actually transferred out of the factory and into a storage area for finished goods. When goods are completed, their cost is transferred from work in process inventory to finished goods inventory. Now, let's go back and talk about raw material inventory. Some of the material was used as direct material. Some of the material is used as indirect material. But we don't use it all generally, and we have some left over. The amount that is unused appears as part of our ending raw material inventory, and it appears on the balance sheet. Work in process, some of the goods are completed and transferred to finished goods. But some of the goods aren't finished, and the ones that remain become part of our ending work in process inventory. With respect to finished goods, some of these goods are sold, and when they are sold, we transfer the cost out of finished goods inventory and take it to cost of goods sold, and cost of goods sold appears on the income statement. The goods that remain unsold become part of our ending finished goods inventory, and they appear on the balance sheet. So all of our ending inventories appear on the balance sheet, and cost of goods sold appears on the income statement. Now let's talk about the cost of goods manufactured. Here's an example of a cost of goods manufactured schedule for Zhang Manufacturing. So if you look at it, oh my God, it's pretty big, it looks pretty threatening, looks like it's more difficult to do than, say, an income statement. But really, it's not that bad. If we look at it, it's got a direct material section, it's got a direct labor section, and it's got a manufacturing overhead section. Then down here at the bottom, we arrive at some totals and factor in beginning and ending work in process inventory. In the direct materials section, if you look at it, wow, this part of it right here looks very similar to the cost of goods sold section for a merchandiser. And so if we know how to complete the cost of goods sold section for a merchandiser, that makes this pretty easy. Because what happens is, just like the cost of goods sold calculation, what we do is we take the beginning inventory, add purchases, that gives us the materials available, then we subtract the ending inventory to arrive at the amount of material used, in this case the raw material used. Now for a manufacturer, they are also going to have some indirect material that they use that's not part of direct material. So we subtract the indirect material used to get direct material used in production, which in this case is $393,000. So it's really not that difficult. We've got the beginning inventory, add purchases, gives us material available, less the ending inventory, gives us the amount of raw material used. Then we back out or subtract the indirect material used to arrive at direct material used in production. The next section is direct labor, and that's real easy. It's only that one, just this one line right here. Look at that, just the one line, direct labor. Typically in academic problems, direct labor appears as just one amount. Then we have manufacturing overhead. The manufacturing overhead cost shouldn't be that big of a problem either, because if you look at it, what happens here is we just list all of the manufacturing overhead costs. So if we have a good idea of what cost would be included in manufacturing overhead, all we've got to do is list them here. Now, this list is just, very small. It's just an example. In reality, companies would have many, 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 many more manufacturing overhead costs that they would include. Some manufacturers have so many manufacturing overhead costs that if they list them in the cost of goods manufactured schedule, the schedule just becomes too long. So what those manufacturers will do is to condense the cost of goods manufactured schedule. This is the same schedule, the cost of goods manufactured schedule, but instead of listing all the manufacturing overhead costs, they simply enter one amount, which is the amount of manufacturing overhead. Typically, it's the amount of manufacturing overhead allocated to products. So now back to our more detailed cost of goods manufactured schedule. We list all of the manufacturing overhead costs, total them up, and we place the amount here. Then what we do is we combine the direct material cost, the direct labor cost, and the manufacturing overhead cost to arrive at manufacturing cost for the current period. These are the costs incurred for the current period. But to get cost of goods manufactured, what we have to do is add in the beginning work in process inventory, and that'll give us the goods available to be finished, and then subtract out the ending work in process inventory. So similar to what we do for the cost of goods sold schedule, we add in beginning inventory and subtract out ending inventory. In this case, we add in beginning work in process inventory and we subtract ending work in process inventory to arrive at the cost of the goods that we completed. This is the cost of the goods that we have finished and completed. However, in accounting, it's usually called the cost of goods manufactured. Cost of goods manufactured. So think of it as the cost of the goods that you finished, that you completed, that you transfer to finished goods. That said, in your accounting textbooks, whether it's a management accounting textbook or a cost accounting textbook, very often it's called cost of goods manufactured. Now let's examine the cost of goods sold schedule for Zhong Manufacturing. It's very similar to a cost of goods sold schedule for a merchandiser, except that instead of buying product ready to sell, manufacturers manufacture the product. So instead of adding purchases, we're going to add our cost of goods manufactured. Now, where do we get the cost of goods manufactured? We just got finished calculating it on the cost of goods manufactured schedule. So let's take a look at that. Here it is, the cost of goods manufactured schedule that we completed just a couple of minutes ago. And we move the cost of goods manufactured down onto the income statement. So instead of purchases, what we do is we show cost of goods manufactured. That's where these goods are coming from. So on the cost of goods sold schedule, we start with beginning finished goods inventory. We add in cost of goods manufactured. That gives us goods available for sale. Then we subtract the ending finished goods inventory to arrive at our cost of goods sold for the period. this cost of goods sold for the period needs to be placed on the income statement, which we're going to do next. So here's our income statement for Zhong Manufacturing. It's the second schedule here, the second one. So we've got our income statement down here near the bottom. And the reason I placed it near the bottom is I wanted to show the cost of goods sold schedule that we just completed at the top of this slide. And so what happens here to complete the income statement is we begin with sales like we normally do, and then we subtract cost of goods sold, and the cost of goods sold comes from the cost of goods sold schedule. So there we go. There's where it comes from. Now, alternatively, what you could do is take this entire schedule and incorporate it into the income statement. So this is a condensed version of the income statement where we just enter the cost of goods sold amount, but some companies will show this entire cost of goods sold schedule in the body of the income statement. You can do it either way. So here we go. We've got our income statement. We begin with sales less cost of goods sold to arrive at gross profit. And then we take our operating expenses, which in this case are $250,000 for sales and $180,000 for administrative expenses. We total them and we get $430,000, which we subtract from the gross profit of $740,000 to arrive at net income of $310,000. So this brings us to the end of our video. I'd like to thank you for tuning in. And if you found this video informative or helpful, please give it a thumbs up. So this is Mike Werner from Miami saying bye for now, and I'll see you in the next video.